Hey guys, what's up? James here from Embark, and today we're actually going to look at something a bit different. We're going to take a look at GameStop, Wall Street, trading platforms, governments, hedge funds, and everything in between. Now, I know this is a slightly different video to what I normally sort of talk about, but I couldn't really resist because this one hits me quite hard emotionally, and it ties in with who I am as a person. I'm pro free markets through and through, and this is a story about a direct attack on free markets and on the little people. So if you haven't already seen the news surrounding GameStop, Reddit, hedge funds, all of that, I'll give you a quick overview now. There was a large hedge fund which shorted GameStop. GameStop is a video retailer, mostly in America, but in Europe and Australia as well. They have about 5,500 stores globally. Since 2015, its stock price has slowly declined from about $50 a share to between sort of $2 and $6 a share, sort of throughout 2019-2020. This makes sense. More people are buying video games online through Stream. They're buying them at Target and Walmart and things like that. So I sort of understand a decline in price, but not that much. In 2019, renowned investor Michael Burry, famous for shorting the housing market in the '08 crash, yes, the guy from Big Short, he took a look at the financials and he realized that GameStop was doing fine. They had a bit of debt, but they had cash to cover it, and they were profitable. Through his investment company, Michael Burry purchased about 3 million shares worth of GameStop. And this was back in March 2020. And he slowly reduced that position, selling up those shares, leading up to sort of September 2020. And at that point, I think he had about 1.7 million shares. So he sort of reduced his position from 3 million down to 1.7 million shares from March to September 2020. But before Burry had an interest in GameStop, there was a guy on the subreddit, WallStreetBets, who put around 50k into GameStop. He saw what Burry saw before Burry saw it, and he sort of made a bet that he didn't think that GameStop would go broke, so he decided to invest money into it. Now, other people in this subreddit laughed, was like, this is ridiculous, this is, it's going to go bust, you're going to lose your money. And he kept posting updates of that going forwards month after month. A few other people in the group also did a bit of digging and having a look at GameStop and doing a little bit more in-depth analysis. Turns out a hedge fund called Melvin Capital had actually shorted GameStop quite a lot, and that's an understatement. So a few things here. What's a hedge fund and what's shorting? Let's take a look at those now. So a hedge fund is a company that pulls together a load of investors' money, and it invests that money into a large amount of financial instruments in order to gain profit and make a profit for its investors. And the way the hedge fund gets paid is it takes a percentage cut of that profit. So that's a hedge fund. But what's shorting? Shorting is effectively a bet that a company is going to lose value. So it works like this. I think that Apple's share price is going to go down. So let's say it's $100 just for ease of calculation. So I go to a broker and I borrow a share of Apple from that broker for a certain amount of time. I then immediately, as soon as I get it, I immediately sell that share. Therefore, I now have $100 and I owe one Apple share to my broker. So let's say my intuition is correct and Apple shares drop to $80. I can now purchase one to give back to the broker, and I still have $20 left over, and the broker has his share back, so everything's back to normal. However, if my intuition is wrong and the shares go up, let's say to $120, I have to buy back the share at $120, the higher price, and therefore I lose $20 and I give back the share to the broker. And it's worth noting that it's very risky in compared to normal investment. Why? Well, because you have unlimited downside. So if I purchase 10 shares at $100 at Apple, that's $1,000 that I've invested. If Apple goes bust, company goes absolute bust, at the most, I'm going to lose that full $1,000 I invested. At the most. No more downside. It's just that $1,000. But there's no possible way that I can lose more. What I put in is what I can lose, and that's it. This is why the most basic investment advice is only put in what you can afford to lose. Now, compare this to shorting. If I borrow those 10 Apple stocks and immediately sell them for $1,000, but the share price goes up to $200 per share, I now have to purchase 10 shares at $200 each to give back to my broker. This means that I'd lose $1,000, the same as the previous example. But what happens if the share price went to $300 or $400? Then you're in trouble, because then you're losing $2,000, $3,000. The downside, the amount you can lose, is infinite. There's infinite losses, infinite downside available when you're shorting. However, Melvin Capital had actually shorted GameStop 148%. Wait, you can short a company more shares than it actually has in existence. How is that the case? Well, basically it's because of the nature of short selling. So take a look at this here. So person A borrows an Apple stock from their broker. They sell it immediately to person B. Person B's brokerage then lends it out to person C, who wants to short the Apple stock. So person C sells the stock immediately to person D. At this point, the same share has been sold twice and borrowed twice. It's 200%. Now, back to Melvin Capital and Reddit. More people from the WallStreetBets Reddit page decided that they wanted to invest. They'd seen a little uptick in the share price and they decided that they wanted part of it. And as the price slowly increased more of them invested. The price of GameStop had already been moving over the past 6 months due to Reddit and Bury, and from September 2020 to January 2021, the price had moved up from around $6 a share to $20 a share. This would have put quite a bit of pressure on Melvin Capital, but not enough just yet to get them worried. Then between the 12th and the 19th of January, the share price doubled to $40. So as the price goes up, the brokerage starts saying, hey, you know, that share you borrowed, yeah, can we have that back now, please? So Melvin Capital has to now purchase these shares from the market to then give back to the brokerage because they owe them the shares. But of course, the price has gone up. So now they're buying the shares at a premium to give back to their lender. But of course, you can't go to a stock like that and start buying tons of shares because the share price goes up. So it's like a self-fulfilling prophecy. The price goes up, they have to purchase the shares to give back to the lender, which drives the price up, etc., etc., etc. This is what's known as a short squeeze, putting tons of pressure on the shorter by purchasing the stock and increasing the share price. Even retail investors got involved, you know, the everyday person that just has a trading app on their phone, you know, Robinhood, Webull, or if you're in the UK here, it will be Free Trade. And in fact, actually, if you pop to the description below and use my link, you'll get a free share when you sign up to Free Trade with my code. And this drove the price up more. So GameStop's share price went from $40 to $470 at its peak on the 28th of January. News sources say that hedge funds, including Melvin Capital, had lost around about $5 billion during this event. This is where it all went wrong. And you might be thinking, sounds like it's already gone pretty pear-shaped right now, but it gets worse. So on Thursday, 28th of January, Robinhood stopped letting people purchase GameStop shares. They cited volatility and protecting customers as their reason, but the actual reason is way more sinister. And we have to look at how a free-to-use app like Robinhood actually makes their money. And that will tell us what we need to know. Robinhood is free to use for retail investors, but effectively Robinhood sells the trades to market makers, and they make money from the spread, which is the difference between the buy and the sell price of the stock. So Robinhood's biggest customer is Citadel Securities, and they pay Robinhood tens of millions of dollars a year to be the market maker for Robinhood trades. They were actually fined $22 million by the SEC in 2017 for using algorithms that screwed over retail investors. So whilst the GameStop short squeeze on Melvin Capital was going on, the hedge fund was crippled to the point of bankruptcy and they had to be bailed out. And they did. They got bailed out $2.75 billion. And guess who bailed them out? That's right, Citadel Securities, who, as Robinhood's biggest customer, then put pressure on them to halt buying. And this is the crucial point. Not halt trading, but halt buying. This meant that you could still sell. But wait, if you can sell but you can't buy, then who's buying those shares? Well, of course, it's institutional traders. It's the accredited investors. They are allowed to, whilst your everyday retail investors weren't allowed to. And what's worse is that Melvin Capital and Citadel actually loaded up their short positions again prior to ordering Robinhood to halt retail investors buying up the shares. This meant that the share price would decrease and they could purchase shares at a lower position and recoup that money that they originally lost from the short squeeze. But this is at the expense of the everyday person. This unprecedented attack on the small guy, the little guy, the retail investors, it's going to go down in history, in financial history, as one of the craziest things that's happened. And times have changed over the past few years. Technology has disrupted many different industries in almost every country. From Uber disrupting taxis, Airbnb disrupting, hotel chains, Netflix disrupting television and movies and cinema, all the way to social media disrupting news and marketing. And some thought that trading apps were sort of next in line. They helped retail investors get involved where previously, it was sort of accredited investors or people earning 200k a year plus. They were the only people that were allowed to invest and were allowed to sort of make money in the markets, whereas everyone else just had to work for a living and that was it. So this was supposed to be letting everyone trade, letting finance for the people. The dollar is losing value every single time one is printed. Nearly 25% of all dollars in existence were printed in 2020. Purchasing power of the dollar decreases with inflation, and every year it's worth less. And people would put cash into the markets every year to try and earn that 2-3% to offset that 2-3% inflation. You were hedging against the fact that the governments were just going to print. This was a David Goliath. This was one of those sort of stories. The small people taking on the hedge funds, a bunch of effectively internet trolls on Reddit taking on an entire hedge fund. It was people trying to take back control and trying to show that they're unhappy with the current situation, playing them at their own game, and they really didn't like it to the point where they had to shut everything down because they were losing. For me, the only real solution to all of this is DeFi, or decentralized finance. DeFi uses smart contracts and blockchain technology instead of using brokerages and banks and centralized institutions that are run by a small subset of individuals who are extremely wealthy and will always be wealthy. Now, I'm not going to go into cryptocurrencies right here, but if you want me to, then let me know. I'm happy to make a little small introduction video if that's something you're interested in. If not, don't worry about it. But for me, that is the only way that we're going to get out of this situation. That is what these past events have shown me. These apps were supposed to be the future for small retail investors, to enable them to hedge against the government, and it turns out they don't like it. They've stopped it. So the only real solution now is for decentralized. It's to get away from the individual gatekeepers. Decentralized finance is putting power back in the people, and it's taking on the monolithic Wall Street. So for me, that's a win. But as I said, if you don't want to hear about that, fine. If you do, let me know in the comments and I might make a little video. So sorry guys, there's a bit of a different video for you. If you liked it, please drop a like. If you didn't, then hey, I just wanted to get that off my chest. Subscribe to the channel if you did like the content and if you want to see more content like this. We have new videos here every single week. I've been James from Embark, and I'll catch you on the next one. Cheers.